Thanks everyone for joining again. This is our first introducing model risk webinar series. What we're going to do this one of these every month. So if you have colleagues or friends interested in QRA and on Monte Carlo simulation on top of Excel, we're going to host these events every month, right? And in two schedules, we're going to have one for the US and Canada and Latin America, which is going to be but this time, and we're going to have one that it's much earlier, that's going to be for Europe, UK, and the Middle East. So my name is Gustavo Vinueza. I've been in this industry for the last 15 years. First of all, first I worked for Palisade, the makers of Address. Then I took a time off in a startup for like 3 years, and then I came back to do what I really like, which is simulation. And with this fantastic tool, which is called ModelRisk, and now we're working with Jameson and I and some former colleagues from Palisade. We are all here because we think that there's a lot of opportunity sharing with you guys what ModelRisk does and all the nice things that it has besides its price level, which Jameson is going to talk about at the end. Right. So who's Bose Software? Just in case, it's a European company based out of Belgium, and what they have more than 20 years of experience doing this, doing Monte Carlo simulation and quantitative risk analysis. First of all, they were consultants, and then they became the makers of Risk, right? And they had three main products: ModelRisk, which has 18 years of the market, and I think that this was last year, so this should be 19 years on the market now. And they also have two other really nice pieces of software. One is called Tamara, which is Monte Carlo simulation on top of schedules, just for you to know. So if you have P6 or MS project schedules, you can add Monte Carlo simulation on top of that. And Pelican is something for enterprise risk management. So all of this, they form a platform and they can interact between each other. So they are a really nice offering, and we are in charge of spreading the word. Right. So what does ModelRisk do? As I said before, it's Monte Carlo simulation on top of Excel. ModelRisk is do risk quantification. It does aggregation and it does simulation. Works on top of any Excel model, which is great, right? Any Excel model, and it follows what we call the MCS, or the Monte Carlo simulation process, right? Which is define your input variables, take your model, right, and take the look to the results as the simulation, right? You have dozens of distributions to choose from. So if you're a newcomer or you're a beginner and you use only 2 or 3, that's perfect. And if you're an expert, that's perfect too. You have more than 130 distributions to choose from, and you can easily introduce uncertainty and risk events on top of any model. And I'm going to show you that in a minute. Just as a quick reminder, remember that the evolution of QRA, right? We start from a static or deterministic model, right? From a single variable, right? And what we're going to do, we're going to take this model when normally we arrive what we call to a number, right? And we're going to generate a probabilistic result, right? That reinforce the risk analysis. That's going to be better for decision making because we're going to add probabilities and risks into the table, right? That's what we're going to do. We're going, and the main thing that we're going to do, we're going to use ranges, right? That's the thing. Instead of one variable, we're going to use a probabilistic distribution. So imagine if you have, I'm going to show you a model like this, like an NPV model. This is the one that I'm going to show you today, right? Where you have volume, price, and price mix. Maybe you have multi-products, you have a cost, you have administration costs, etc. And then you do a cash flow analysis, and at the end you get your project metrics like your NPV, your payback, your IRR, etc. Right? So what happens in traditional methodologies is that you will have these results based out of one value for each assumption, right? Now, with Monte Carlo simulation, what happens is that each one of the variables, remember volume, price, cost, AMP, etc., they are going to have distributions like this. Going to have distributions. meaning that you can replace potentially each and every variable of the model with a distribution, right? Then model risk is going to be here in the middle, right? Why? Because we're going to run what we call a Monte Carlo simulation process. And this Monte Carlo simulation process is going to let you simulate the model and recalculate the model thousands of times, right? So imagine somebody recalculating this times and times and times. So this is what that's going to happen today, meaning that during the Monte Carlo simulation process, each and every one of these distributions is going to be fetched, is going to be asked for a sample, right? And this sample is going to be random, and this random sample is going to be coming to each one of these variables. So it's going to replace the static value that we had before, that we had originally. The model is going to be recalculated, right? The cash flow, and then we're going to have a table with results. In this case, could be, for example, a table with NPV calculations. And this is going to happen thousands of times in less than a minute, right? So that the result is now a range of potential values generated by the simulation, right? Used in the input variables and then translated or transferred through the recalculation of the model to the output variables. That's what we're going to do. So please remember that we're going to move from a point estimate, the point estimate that we started with, to a distribution, right? That's the change in the paradigm, right? Perhaps in this case, for example, you had a cost, 280,000, let's say. Now, this was the point estimate, and then after entering your information into the model, now you get a distribution, and this is what's going to happen, right? Now, let's start with the model, and I will come back to this slide here, right? So I have this cash flow model here. It's a static cash flow model, right? A very simple model here that has the typical variables, the ones that I was showing you before, right? You have an investment, of course, it is a project, you need an investment. You need the sales growth rate. This is going to be, let's say, yearly, so you have 10% average growth. You have a base sales of $900,000, direct cost, indirect cost, and an inflation rate, right? So what the model does, you see, it starts with the revenue of 900. You see here, revenue 900, right? And what it does, it multiplies the 900 times the growth, like this. And every year, it uses the growth to increase sales, right? So it's static. You see, it's totally static. It says every year you're going to have 10%, right? Because you're using the average. The direct costs are here, 250, right? And they grow with inflation, like this, right? So you multiply the 250 times inflation. So every year you're going to have inflation applied to each one of them, like that. Yeah, so have the direct cost, you have the revenue, you have the indirect cost, which is 36%, as it says here, of the revenue. So whatever the revenue you have an indirect cost of 36%. And finally, what you have is your operating income, which is basically the revenue minus these two, and the cash flow that you have here, right? So if you can see that, or if you like to see that in a typical graphic, this is what you're going to see, right? You see the investment, initial investment here, and you see the typical cash flows, right? And it seems that that this is going okay, right? We do calculate an NPV of 10% for it. That means that our NPV is going to be calculated for all this. Maybe I can set it up for the whole calculation. It's going to be even better, like this, right? And my IRR, let's see, is going to be even better, I guess. Take a look. So we have a 34% IRR. In this case, positive. That means that we should invest in this project, right? Now, let me do this with simulation, right? Because this is our static model in Excel. Remember, this is where we started. So with the static model in Excel that we have, what we're going to do, we're going to replace, for example, the investment that we had at the beginning. We're going to talk into ranges like this. We're going to say that the levels of investment could be between 1 and 2 million, with a most likely level of 1.2 million. You see, very close to the 1.3. But what's going to happen is that we're going to build what we call a distribution between let's say 1 million, 1.2 million, and 2 millions here, right? We're going to build what we call a distribution, a per distribution like this, right? To be like this, right? So that means, and internally you will remember from statistics in college maybe, right? Internally you will have something like this. That's a distribution where we're going to fetch the samples from, right? We're going to say in the tails where we have here, we have less frequency, meaning that we're going to get less values from these tails, and we're going to get more values from this area where you have a higher frequency like this. The y-axis is the frequency, right? Now, we're going to replace the investment with that value. For the growth, we're not going to say that every year is going to be 10%. We're going to say it's going to be between 0 and 25%. The sales, the base sales are going to be between 500 and 1300, etc., etc. For each one of them, we are not going to set them up as static values anymore. We're going to use ranges, right? So how do we set it up, right? And please write to me. I'm going to put my email in the chat if you want this model, right? Fairfieldgroup.com, right? So how is it that you do that? I'm going to do the first one, right? The investment model. For the investment, what I will do, I will go to model risk. You see that model risk sits on top of Excel, right? For you, if you were a previous user of @risk, you will see that it follows the same paradigm, right? First of all, you select the distribution here. And as I said before, you have a plethora of distributions so you can choose from. So I will choose the per distribution, which is in my most used distributions, but you have also a nice palette with all these classifications that categorize the distribution, right? So I would say it's a per distribution. I click here. This is my per distribution. And I will say I want my minimum, most likely, and maximum. Every distribution has a set of parameters. These parameters, you have to set them up in order to build the distribution. So I will say here, this is my minimum. I click in OK. This is my mode, or my most likely. And this is my maximum, like this. You see, this is going to generate more or less the same graphic that I showed you before, right? That is going to be between 1 million and 2 millions, right? With a most likely value of 1.2 million, which is here, right? Which is the mode. Now, that's great, right? Then what we can do, we can click here in where it says insert to worksheet. Super simple. And now we have our first distribution. I can press F9. And if you focus on the green area, you will see that each and every one of them is a distribution too. You see, you have a per distribution here, you have a triangular distribution here, right? You have a triangular, you have a normal distribution, you will remember the normal distribution, you have a log normal distribution here. You can see all these distributions by just clicking the cell and clicking the view function, and this is going to bring up the distribution that you have defined. Now, you will see that for every one of them, I had something that's called a Gauss input, right? That's basically, imagine that you're writing an equation for a model, or you're writing some type of mathematical function. So you will have names, you will need names for each one of them. So what I will do, I will take this variable here, you see it's this distribution, and I will name it investment. So how do I do it? I go to the cell and I will say mark as an output or as an input. I would say it's an input. And the name, I'm not going to write down investment. I was just going to link the investment here like that, right? I click in OK. And now you see that automatically I have the Bose input B6, which is the investment, and Bose per, which is the distribution. I already did this for each and every one of them, right? So as the model was linked, as I explained before, as the model was linked, so every time that I press an F9, what I'm doing, remember what I explained before, I'm getting samples, random samples for every distribution. So as I have 6 distributions here, I am getting samples from the 6 distributions. What is good about this is that it reflects reality because all of these distributions move at the same time. If we think, or if we apply the typical ceteris paribus where we say everything stays static and then only one variable moves, that's okay for doing sensitivity analysis. But that's not okay for Monte Carlo simulation or for reality because all of these, they move at the same time. Like that. As the model is connected to all of this, right? You can do this here. Imagine if you are in the NPV, you're going to see precedents, and these precedents are going to all apply here, right? That's why all of them are moving, because everything is interconnected. Now, what you can do, right? Imagine that you're going to do this thousands of times, meaning that imagine that you're the NPV cell. So we'll have to say, oh, for that scenario, it was 1408, right? For this scenario, oh, take a look. Minus 1.2 million, then 2295, then 3321, then 569, etc., etc. So if I do this 1,000 times, I should have a placeholder, a bucket where I will place all of this. So how do I do that? I do what I call an output cell, right? So how do I define one? Because this is the typical NPV calculation, right? And this is my IRR calculation, the same calculation that I had before. But they are going to be dynamic. Why? Because they change with every scenario. So what I will do is exactly the same that I just did. So I go to model risk here, go to output input, and I will mark it as an output. And the output is going to be called NPV, like this. Right? And then I click in OK. So what happens is that for every one of the scenarios, I am going to use, and I'm going to utilize a placeholder here where all of these are going to be included, right? Now, we're ready to run our first simulation. And here before we do that, what I have here in the material, let me show it to you, and then I will come back to this, as I said, right? You have the probabilistic distribution, so you have to pick and choose, right? And here we have a step-by-step of what I am doing now. So besides the file, if you want to have the file, I can send you the presentation as well. Why? Because what I did is I depicted step by step how is it that you add probability distributions to the model, then you have your output results into the current model, right? And even how you add and you create the formulas. Remember, you have the Bose per distribution, for example, and then you have the Bose input, right? So you can name the variables, right? And then you add the Monte Carlo to the outputs, etc., right? So you have all the process documented in any case if you want to use it. Now, what's going to happen, you see that I have these two output cells. You see, I have my NPV here, and I have also my IRR here. And I also have a flag that it says, if my NPV is bigger than 0, I should invest or I shouldn't, right? Why? Because there's a condition here. There's a business condition that if my NPV is less than 0, I should not invest, or in this case, if it is equal or less than 0, and if it's bigger than 0, I should invest. So let me run the simulation and you will see what happens, right? So I will go to start. This is going to generate this. It's going to generate like this, you see? A progress bar that reads, I'm going to run this for 1,000 times, and I'm going to get the output of the model. So the output of the model, let me see here. I just want to show it to you step by step, so it's a simple one, right? So the output of the model, of the NPV model, is here. Right, let me show it to you, right? You see how is the model coming? Yeah, the model has the risks, great. This is your NPV, like that, right? Like this. So my NPV, what it says, take a look here. What it says, it has these sliders. Let me show you here step by step. So if I take a look to this histogram, this is the histogram of my NPV. What it says, and I always go here first, I go to the min and max here. It says that you could have a minimum of 2.7 million and a maximum of 8.2 million, which is this, right? So this is interesting because it can be negative, right? It can be less than 0. It has all this probability of being less than 0. So what I did here is I added what I call a marker, which is here. I go to markers, and I added one that says x equals to 0. And what it says is, what is the probability of x being less than 0, right? What is this triangle? And this triangle, it's equal to 12%. So that means that I have 12% probabilities for my model to be negative, for my NPV to be negative, meaning that I have 88% probability, which is all of this, for the NPV to be positive, right? Remember that the complete histogram is always 100%. So if I have 88% probabilities of being positive, maybe this is a good project. Maybe I will have to do it. But right now, you see that the modeling and the scenarios that I built are much more robust than the initial scenario where I had only one of them. In this case, I consider the negative scenarios, right? I did consider the negative scenarios, taking into consideration one other component that I'm going to show you in a minute, right? But I just want to double check on the cash flow, right? So what I did, I took a look to the minimum and maximum, right? The 0 and the reference value, what's the probability of being 0, right? So that's what I would do with NPV. Now let's imagine for a second, because you will say, but what happens if I do a cost estimation like this? Right, in a cost estimation, you will have the min and max, definitely, right? The min and max. But also you will have the reference value. Like I have my 0, for example, this could be my original estimation. But also what you will have is a percentile table. This is going to be reflecting your risk profile, meaning that, for example, you can say I want to have a cost estimation that it's located here in my P75, right? What is my scenario where I am protected 75% of the time, right? In this case, it's going to be 2.9 million, right? But the main idea here, if you're doing a cost estimation, right, is that you can choose any level of protection that you need, any confidence level, right? So instead of always going with the mean, you can also say, I just don't want to be protected at the mean. I want to be protected a little bit more. I need more cushion because the project has a lot of risks, right? So if you're doing cost estimation, remember that this is an additional step that you can take, additional to the mean, max, and reference value, okay? And we have videos about that. So at the moment that you go to our video library or to our YouTube channel, you will have this. Now, let me go back here to the NPV model. So I have 12% probabilities of having a NPV negative. And what I will do is I will double check this result, because here in the model, maybe you didn't see it, is I have one additional line, right? It's the strategic risks line, right? That means that additional to the original model that I had, I added one line with additional cash flows, right, which are negative. You see, I decrease this because of the risk, because I am taking into consideration not only the uncertainty. Remember that here I am taking into consideration the uncertainty of the variables. Right? I'm not only considering that, but I am also considering what we call strategic risks or project risks, right? And on purpose, I included that here. So how do you see strategic risk inventory? You see it something like this, right? And I'm going to explain it step by step, so you don't worry. I'm going to show you like this, right? So you will have here, first of all, an inventory of risks. This inventory of risks are, imagine, logistic delays, terrorist attacks, community problems, strikes, cyber attacks, earthquakes, exchange rate exposure, etc. it can happen every how many years here, because normally the model is in years, it could be in years as well, right? So a logistic delay maybe every 3 years, right? A terrorist attack every 10, community problems every 2, exchange rate exposure every 3. You see, so that's going to change the change of occurrence as well, right? Now that you have that, this model is special because the model has internally business continuity logic. Let's imagine that you have a merger and acquisition, so that's not going to continue the business. Or imagine that you have an expropriation risk, depending on in which part of the world you are, you have that. Now that you have that, right, what you can do is you can model how many times this is going to happen, like this, right? So you see that what we're doing, we are using what we call a discrete distribution that has all these probabilities. For example, here this is going to be a little bit bigger. So, for example, a logistic delay is going to have maybe every 10%, right? And it occurs more than once a year, like this, right? Or even more, imagine 30%. So this is going to model how many times, let's only focus here. This is going to model how many times the risk happens every year, right? And here you have a cell that says if the risk occurs more than once a year. Imagine you have a strike can happen more than once a year, but perhaps a cyber attack can be only once. It depends on the industry, of course. A flood, maybe once every 2 years, 3 or 4 years, right? So that's why these probabilities were added as well, right? So let me hide this so we don't have so many things, because this is going to grow, right, like this. So what we're doing here with, again, a distribution that it's called a Bernoulli distribution or a Poisson distribution, depending on what you have, if it's multiple or not, right? This is going to model, for example, here, how many problems, how many community problems you have. So you can take a look here. You see that the shape of the distribution is totally different. That's why I wanted to show you this, because when you model discrete events, you model how many times a risk could occur, right? A machine could fail, how many times a customer success ticket could arrive per day, etc., etc. So you count how many times, right? And that's why we have discrete and continuous distribution, and this is all in the material here. So what happens? Let me go back. Remember, I'm simulating how many times the risk occurs. And if the risk occurs, imagine this is by year, right? So basically we are predicting the future. This is what we're doing. This is our best guess for predicting the future. And what we're saying is that for every time where a logistic delay occurs, it could take from 400,000 to 3.5 million, right? So what happens is that the severity of the event is going to be calculated here as well, you see? So in this case, for year number 2, we had one issue with the logistic delay, and that issue is going to cost us 2 million. And we also had one in year number 10 that is going to cost us 1.2 million. You see? So that's how do I do that? I'm going to multiply, and this is the last one. Take a look here. So I'm going to multiply these two. Like for example, here I have an event in year number 3. Year number 3 is 1.5 million, which are here. So this 1.5 million, you see that you don't have anything else for year 3. This 1.5 million is going to go to the model like this, 1.5 million in year 3, right? So basically we are building it from the ground up, right? What we call a risk register, right? So what we're doing is affecting my NPV calculation, right, with this risk register, with this strategic risks cash flow. That is this. That's what makes this model so powerful, because it adds the uncertainty of the variables, like for example, the level of investment, the growth rate, the cost, etc. And then also you have the strategic risks. Everything in the same model, right? And everything points to a financial cost in that case, right? So it's a very powerful model. Once you finish that, right, imagine you can have 3 millions in risk, or you can have 3.3 million, 3.2, 2.3, 6.5, it's super high, etc. What we do, we included these into strategic risks, right? And that's why you have our NPV calculated here, right? What you can do also, and this is something that you can do in the model, is you can do one scenario with strategic risks, one without. In this case, we're going to use only the one that has strategic risks, right? You can see that. So that's why I wanted to show you that. So let me run the model again. So remember, you go here, run the model, and we're going to take a look to different artifacts or reports that you can get from the model, right? But now you're taking a look to all the things that you can do. Remember, we're considering the strategic risks, right? And we're taking a look to the NPV. Now, what else you can do? What you can do is you can generate what we call a key drivers analysis, because we have so many variables. I imagine that if you're in capital project, as I know as my friend TG, or maybe in Regina's case, and thank you for coming, Regina, or Yasir, so thanks for all for coming, right? You will have different and complicated models, right? The one that I have now, it's very, very simple. So what I can do is I can go to insert, and I will say insert a tornado chart like this. On this tornado chart, I'm going to say I want to analyze my NPV like this, right? Let me show it to you here. So I'm going to take into consideration my strategic risks, of course, and this is going to be my NPV. So first of all, before you see even the numbers, take a look to the order of the variables. That's the important here, right? Forget about the numbers here. So in this case, what you have, let me see here, is that your sales growth rate is the most important variable. Most important variable is your sales growth rate. You see that sometimes in these financial models, people will say, oh, no, you have to take a look to each and every variable, and let's work through each and every one of them. And maybe the inflation is the biggest one. You see that we tend sometimes to blame on others, right? To blame the government. So inflation rate is the variable that affects the model the least, right? So we're not going to take a look to the inflation rate, because this is something that affects the model the least. Now, what is this saying? Now let's get to the numbers. What it says is that if you have a very low sales growth rate, low meaning here, this could make the NPV negative. If you have a very high growth rate, this could make the NPV positive, right? Because we're always doing the analysis for the NPV. Same thing with the base sales. If the base sales is low, your NPV is going to be negative. In your sales, and if your base sales is high, your NPV is going to be positive, like this, right? Take a look to the investment weight. It's not that bad. You see, always the investment is negative. That's why if it's very low, it's going to make it negative, and it's very high, it's going to make this less, right? So you have to take a look to that. It's important to know what is this telling you, right? Always my recommendation is, first of all, take a look to the order and the magnitudes of the variable. This, I normally call it the scope of the variable, right? Why? Because the scope of the sales growth rate goes from minus 1.8 million to 1.4. So you can sum up the two, it's going to be like 3.2 million. So this is the scope of the sales growth rate. So this is how much, if this is a chopper or a plane, how much you can move it, right? You can move it 1.8 to the going down, 1.4 going up. The same thing with this. This could be like the levers of a cockpit, right? You can imagine like that. Now, the software ModelRisk has 8 tornado charts. I'm just going to show you 2. This is the first one, and this is the default one. And also you have one that I really like, that it's called the proportional contribution to spread. That, of course, it sounds like a really difficult one, right? But what it does, and I'm just going to focus on the NPV first, right? It tells you what's the percentage of the, in this case, of the risk explained by each variable. So it says here the sales growth rate explains 50% of the risk or the variability of the model, right? And 30% is explained by the base sales, right? So this is always going to sum up 100%. Of course, you have to take into consideration the summation with absolute here, but between these two risks, you already have 80% of the risk of the model. So that means that your focus, as with the previous tornado chart, your focus is going to be in sales, right? So if you want to improve your NPV, you have to change sales, right? So what's going to happen, right? What's going to happen if you move one of the variables, if you move the risks, etc.? Because you see here you don't have any risk included. I did it on purpose. You see that you have the strategic risks here. How is it that this is so well organized? Because I have the both inputs here. This is why it is so well organized. It's so simple. So what happens if you want to see now the tornado chart, but you want to include the risks here? So you click here and see which percentage of the risk in my total NPV is going to be explained. And take a look here. The logistic delays is the risk that's going to be the biggest one. And why is that? Because I changed the probability of it. So on purpose. I did it on purpose. I changed the probability of it. So it has a very big impact on it. So you can see it here. See, you can go here to the logistics delays like this. You remember that it was here before like 2%. I changed it to 3. I'm sorry, I changed it to 30. So if I do it 3%, take a look here. I run the model again, right? So the probability of happening is now 10 times less. That means that we should expect a much smaller impact. So you see, take a look. Logistic delays, it's here. Right? So this is normally how you do Monte Carlo simulation. You take a look to the results, you generate a mitigation plan. It's always a call to action. All these graphics here, and mostly the tornado charts, are calls to action, meaning that they are tell you something that you should do. In this case, for example, the growth rate explains 40 and the base sales like 70% of the risk. So let's take a look to the model again. I'm sorry. You can go back to the results here and go back to the histogram and say, so remember, it was like 30%, 12 or 13%. That's good. So what happens if you say, well, but this is too optimistic. This is way too optimistic. What if, now that I know that sales is the one that I need to take care of, you see, it goes up to 25%, but in the lifetime of this project or this company, I've never had something with such a big growth. So why don't we make this a little bit more, down to earth, and we go 5% and 12%, right? Because this is the variable that's the most important variable in this model. So I run the model again, you see? The model runs, and it's going to show me again the histogram. Oh, so you take a look. Now that I make it more realistic, 0 to 5 to 12%, oh, now I see it. I have 30% probability, right? Probability for my NPV to be negative, right? So now you have a really important insight here. In the tornado chart, take a look here. The base sales, they still have the responsibility of 50% of the risk, you see, but the sales growth rate is not, you see, it's now 9%. Why? Because it decreased. So now it's not as dominant as it was before, right? And the logistic delays, they still have the biggest impact. Now, what happens if you just want to do the analysis of the strategic risk, right? Because this is maybe for the project manager, right? You want to see the project as a whole. But what happens if you say, that's totally fine, but I don't have any, I'm not the person from sales, I'm not the person of cost. I am just, not just, but I am in charge of the risk management of the project. I don't have any authority in these other things. So what I can do, I can go here and I go to the strategic risk exposure, right? And I will say, this is the strategic risk exposure, right? This is how much I could spend because of risks, right? So now we're not talking about an NPV. We're talking about a number, a cash flow, right? So basically, you're looking at the cash flow. This is the total one, right? If you want to see the formula, you will see that here, right? So you see the cash flow here, right? Yep. I'm sorry, I'm just asking somebody to come in 15 minutes, so we don't have a delay here. So this is what we have here, right? It's the summation of everything, right? So now that we have that, let me show you the results here, right? So what you can do, besides, now you're an expert, right? Besides the minimum, the maximum, right? Besides taking a look to what's the probability of, imagine that you want to calculate, and that's why you have the markers here. Imagine that you want an X that says, I want to see what's the probability of me spending $1 million because of my risks. Here you go, 63%. So you have 63% probability that you're going to spend $1 million or less. You have all of this, right? And you have, in this case, 37% probability that you're going to spend more than $1 million, right? In this case, 37% or 27, I'm sorry, 27% probability that you will spend more than 1 million, which is this, right? So this is very eye-opening, you see, because you can drill down, depending on how you model, you can drill down in all these different questions, right? Now, what if I want to do a tornado analysis of this? So I go to my tornado chart, and now I analyze my strategic risks. And now my strategic risk, of course, I don't want to include the cost. They don't have anything to do here, right? And what I can do, I can go back to my first tornado chart. Remember the tornado chart of conditional mean, that one. You see, again, logistics delays, earthquake, strikes, change rate exposure, etc. So now what I do is I can see what are, in this case, what is the ranking of my risks, meaning that I can prioritize and I can allocate resources for them. So if I'm going to prioritize, I don't know, a team specific or cyber attacks, and maybe I am in the construction industry, maybe this is not going to be as common as having a logistics delay because I have to import a lot of pipelines from any other country, right? Or let's say I'm in a very sensitive region to earthquakes, so maybe I have to put some seismic protections to my warehouses and things like that. I have some potential strikes because I am in the gray area, imagine in the construction zone because of expropriation, etc., etc. You have all of this. Every project is a different world, and we know that. So now I change the granularity of my analysis. Before, my granularity was much more general, the project, and now I did it with my strategic risks, risk by risk. Of course, what I can do, I can change the tornado chart to this one and say, 66%, again, logistic delays. So I have to talk with the person in charge of logistics and say, well, what is it that we're going to do in order to reduce that, in order to mitigate it, right? And then again, it's a call to action. So we're going to generate an action for that, right? So what is it that we gain? And I'm going to go back to this slide, right? Let me show you here because I really like this one, right? So what is it that we gain with Monte Carlo simulation, right? First of all, we have an order of magnitude in our head, right? We have a minimum and maximum, right? We can understand the behavior of the variable, right? How is it that it looks like? It has a tail, it's symmetric, how it's in this case, it's biased to the right or to the left, right? You can calculate contingencies, right? And this is what I was talking about before. Remember a P50, a P70, a P80, right? You go and build and you add probabilities to the table, right? And finally, what happens and what is it if we have outliers, right? So this is everything that we have in a probabilistic model that we don't have in a static model. So for us to know, and this is a really good starter of a conversation, is that if we follow this framework, when we see the magnitudes, if we see the reference values, if you calculate the contingencies, right? And obviously, if we try to answer the difficult question, the best question, this is what we're going to bring to the table, right? Outside, of course, all the information that I brought in terms of the key drivers. Remember, the key drivers that are going to come with the model, right? So what else do we have, right? And this is something that I left for the end. So what happens if you want to analyze the cash flow, right? Remember, because all of this was changing too. So what if you want to analyze the cash flow? So what I did here, I set up the cash flow with the model input output, as I did here, right? Now the names are going to be the names of each one of them, right? And you have a range name named cash flow. So you will see that in the model. So when you open the result, you can open what we call a trend graphic. So I'm going to come here to the cash flow and open and insert what we call a trend graphic, like that. I'm sorry, this is scatter plot. You can do scatter plots too, but I want to focus here on the trend graphic. And this trend graphic, take a look here, is going to give me the cash flow behavior. Take a look here. So the cash flow behavior, it means, let me change this color to something less dramatic, like this. Oh my, it's even worse. Hold on. Like that, maybe here. Last one here, right? So in gray, what you have, right, is each one of the ranges from my cash flow. So imagine that you have a distribution here that is upside down like this. And also you have another distribution which is upside down like this, right? Same thing here. Right? And why is that? Because you have a higher probability of being negative than being positive. Remember that what I did is I decrease the sales growth rate. So that's why you have this shape. So this is something that you will never see in a static model, because in static model, you only see the red one. So this is what they call the tip of the iceberg, right? Tip of the iceberg. Why? Because you only see this, you only see the nice thing, right? But you don't see how low it could go. Take a look here. So it could really bad. Now, if I change this again, if I change it to what it was before, 0, 12, and 25, we'll run the model again, right? So this model now is going to show me the cash flow, but now with the initial one, which is the initial scenario, which was, you see, much more optimistic. And this is what happens, right? Normally when modeling, right? That sometimes you don't have a way to see and visualize your bias to the model. In this case, you see it's very simple. With a trend graphic, you can see if you're optimistic or you're pessimistic. Remember, in the other, you have something like this here. And also you have a higher limit in the upper portion, right? And remember, what you have here is the distribution of each one of them, right? Like this. So this is what you're looking at right now. So this is one of the next options in what I call the next options in modeling, right? I really like the confidence intervals for forecasting, right? And what's the probability of each one of being negative, etc. Right? That's something that you always need to do. And what you can do as well, you can, let's say that you want to analyze with a histogram, you want to analyze, imagine you want to analyze here, I think it's cash flow number 1. So you see, it's always negative because that's the investment. But if you go to cash flow number 2, you see, now you're making a little bit of money and you have 0. So you have a probability of being in 0 or not, right? Then you have cash flow number 3, cash flow number 4, 5, etc. You can change the cash flows to look like this, etc. And of course, you can change the mark. Remember that the marker here is key, so you can change it to 0. So you see what's the probability every year to be below 0 in your cash flow, right? So that's really important. Of course, in the first one, you will have 100% because your cash flow is negative, it's your investment, right? So that's something else you can do. So you see that from this very simplistic model, because it's a very simple model that you have here, all of the things that we could get. So this is the next step, as I like to call it in the trend, to use the trend graphics and to analyze each one of the cash flows. And you can analyze with all of this framework to each and every one of the outputs and the variables. Now, what else you can do? And we decided to give 5 minutes for previews or formerly at-risk users. A couple of things that you can do. One, you can change the ribbon. You see that you have this ribbon here. You can change the ribbon to standard to at-risk style, meaning that the moment that I change that, I'm not going to change it because sometimes I have to reboot the Excel. But the moment that you change that, your ribbon is going to have all the buttons exactly in the same way that you had in at-risk. So this is one. Number two is that you can convert at-risk models here. You can convert the current model from at-risk, or you can convert a folder full of models from at-risk. So I'm going to add into the chat, I'm going to add which are the steps by steps and how is it that you will see it. And of course, in the presentation, you will have, right, what happens here, right? As I said, you have the ribbon, you see, take a look here. The ribbon goes from here to this. You see, you have the exact same at-risk. So you make it easy for learners, right? You can change the language, which is really great. You can do model conversion, right? Which is very simple. You just say convert the model, and the model is going to give you a complete report of all the cells that it converted, right? And it generates a new model for you to use. So this is something else that you can do. Plus, and this is something that we've been looking at during this whole hour, the graphical presentation. Graphical presentation has, I mean, no competition here. This graphical platform is a complete, it's like a sandbox where you can add more and more things, right? If I want to add statistics, I will have the statistics, right? You have data lists, etc., etc. Thank you, Yesir, for the comment. Yes, and you do escalation as well. So all these things are the things that um, differentiate ModelRisk from the different competitors in the market here. What I like to say, and also from at-risk as well, is that one, remember, you can convert the ribbon to at-risk. You can change the language immediately, right? So you can do it immediately. That's number two. You have the converters. You have the converter of the current model. You have the converter of a folder. So if you have 20 models, you can put all your models there. This is going to be converted, right? In terms of next steps, and thanks everybody for staying this whole hour, right? I know it's May the 1st, so some of you maybe had holiday. What you can do, model risk trial. This is what I would totally recommend you to do, is take a look here. I will send this to you. You can download this. This is going to give you a 15 days full feature installation that I really like. You don't need to wait for any email or anything like that, right? Let me see questions that I had here. How to account for interaction effects between variables. If you have, for example, inflation, which causes positive or negative impact, what you can do, you can add correlations. Let's imagine that you have a correlation here between these three variables. So what you can do, you can select the variables. We had a correlation webinar that I can link you here to. So you can say in model risk correlation multivariate, and then we can add the different correlation coefficients here, right? And then you can just put the correlations here, add the labels if you like, to make it very formal, like this. You see investment, sales growth, and I will say, let's add the correlations here. And I insert it to the worksheet. And I will insert my correlation matrix here, like this. See here, my 1, 2, 3, like this. Here you go. So now I have my correlation matrix here, and everything, and these three variables are going to be accounted for interaction, the variables like Anan asked. So thank you for that.